Okay, so basically, what happens is when you're self-employed, no one is taking Social Security taxes out of your pay and matching it. That's what happens when you have a wage. Is that someone's taking 7.65% out of your wage, that's your half of the Social Security, and then the employer's matching that, so 15.3% is going to the government, and that's basically your Social Security contributions. Now that you're self-employed, no one's doing that. So here's how the IRS handles that. If you're not incorporated or set up in an S-Corp, you're just going to be a Schedule C, which is like a sole proprietor. And on your 1040, there's a form called Schedule C, and you pay your income taxes on that just like any other form of income. The difference is that they make you pay a self-employment tax. That self-employment tax, which is 15.3%, is the equivalent of Social Security.
Oh, okay.
So that's how they would do it if you didn't have an S-Corp. Okay, that's the simple way of filing tax returns when you're self-employed and you haven't set up in a business, a formal LLC or a formal corporation. They just handle it on your tax return, but it's a fairly big hit. It's 15.3%. So if you're thinking about this, I mean, if you're making, I don't know, a lot of people make more than this and you make more than this, but let's say the average person's making $50,000-$60,000 a year, okay? They're getting by. I mean, that's not getting rich by any means. They're surviving, okay? And their income tax is that level, maybe $2,000 or $3,000 of income taxes because they've got kids and all these different things that they're getting write-offs for. But their self-employment tax is just a flat 15.3%. So 50,000 times 15% essentially is $7,500. So on top of the 3,000 whatever, there's another 7,500. There's $10,000 of tax, and they're making 50 grand. That's horrible.
That's a lot of. Yeah.
It's crazy, and a lot of people come in here having no idea that's going to happen to them, and it's bad news. Okay, so I would say it was in the 80s sometime. It was right around the time I became a CPA actually, and I was young like Sneho. And, Congress came up with a good idea once in a while, and that was the S-Corporation, okay? It took care of this problem. Basically, if you're self-employed and you set up a business and make it an S-Corporation, which at the time stood for Small Business Corporation. That's what it was, okay? And it's different from the big companies. Like there are C corporations, like you got Exxon and Google and all the big public companies. Those are C corporations, and they file a different kind of corporate return. It looks similar. In fact, it's actually pretty similar. It's just that one's an S and one's a C. And the only difference between the two is that the C corporations, the big guys, file a return, show their income, and they pay a tax. They directly pay the tax to the government out of that corporation. S corporations don't do that. It files a return, so you see income and different expenses just like you'll have in your corporation, and there'll be a net income on there, but you don't pay a tax at that level. Instead, that income flows over to your 1040, kind of like your W-2 did, okay? So we pick up that, it's called a K-1 from the S corporation. It gets picked up on your 1040, and on your 1040, it just becomes another line item of income, which you will pay income taxes, very similar to the Schedule C method, that easy method, okay? The difference is that there's no self-employment tax on that. So huge, big savings for small businesses. All they got to do is set up an S corporation, do business the same way they're doing it. It's a little more complicated in filing. There's another filing now on a corporate tax return, but the big difference is that income that flows over onto your personal return via that company is subject to income tax, but not self-employment tax. Okay, now that's the short story. Okay, the longer story is that, okay, that's great. Got out of, in this case, $7,000 of self-employment tax. Well, what about Social Security, though? That means I'm not paying anything to Social Security. Well, the IRS says, well, that's not really right. That's like kind of cheating the system. So we're going to buy off on this concept, but to the extent that you work in your business, which is pretty much everybody. There are some that don't. There's some passive investors that have people employed and they don't do a dang thing and they're totally passive. Maybe we can justify them not getting a wage. But to the extent you're working in the business, you need to take what they call a reasonable wage. And on that reasonable wage, you're going to have the same Social Security tax like any other employee being paid into the system. Half coming out of your wage, half matched by your company. Okay, so you're still back to paying both halves. Okay,
but it's at a much smaller.
But it's on what
rate.
we call a reasonable wage. It's on the wage amount, not the full amount. So,
Okay.
so that's the savings. Okay, because the IRS says, hey, you're really two people. You are the owner of the business, and you're the employee in the business. To the extent you're the owner of the business, you get profits because you have a business. You've got capital involved, and you've got expertise as a business owner. You're taking business risks. You're not employed by anybody, okay? So to that extent, you get a profit, and that's subject to income tax, but not Social Security, not self-employment tax. Just like if you had dividends from Google and dividends from another big investment, you would not pay Social Security taxes on that. But to the extent you're working, you need to have a wage, and that's where you're paying your Social Security taxes paid in, okay? Now, the key then is how much do we pay yourself as a wage? And honestly, that is the big question. There is no answer to that. The IRS, and that's why there's a lot, people say tax law is gray. This is a very good example of a gray area of tax law. When they come in and say it needs to be reasonable, what does that mean? Okay, and instead of saying a formula or something, they just say, it just needs to be reasonable. So what we've kind of done, and a lot of other tax preparers have done, is just try, okay, what's reasonable to these guys? Okay, well, there's really two answers. One answer is there is kind of a way of determining what reasonable, and it's taking comparables and what people in your industry make and all these sorts of things, which is not easy to do, candidly. Or maybe there is kind of a little quickie way of estimating it, and it seems to be maybe a filter the IRS set up and just let that flow through. And it seems like that we just had a trial error over the years. We found that it's about a third. It's basically between a third and a half. Okay, half being those that are more professional involved. In other words, let's face it, a doctor or attorney is going to make a higher wage than a store clerk. Mm-hmm. You know what I'm saying? So, but even in the store clerk's example, where if it's an owner that owns the store and works in the store, we're going to probably we don't like going below a third, and then we don't need to go over a half. Anything over half is just kind of a waste. Okay, so a lot of our clients were closer to that third mark, candidly. Okay. So back to the $75,000 example, if that's what you're making, say we're making $75,000, a $25,000, which is about a third, would probably be okay. Okay. So we set the wage at around that level. So far, in fact, honestly, I've had none. As long as someone in 30 years, I've never had anybody questioned, as long as they're keeping at least to a third. Okay. There are other practitioners out there who say, we like the half. Maybe they're more conservative, and that's fine. I leave it to the taxpayer, And honestly, I would not say this in front of the IRS because I don't want them knowing that's what we're doing. It's just taking a percentage. But so far, it's never come up. If it did come up, we would say, well, we did this and we did that to come up to the wage. Okay. Now, the one examples that I have had a problem with the IRS is when it's less than a third. I've had a few of those, especially if it's way less. And there are people out there that just take advantage of it. They're making $100,000 a year, and they pay themselves a $10,000 salary. They'll get away with it for a while because the IRS is not that efficient at catching on to people, but eventually they're probably going to get caught. And when they do get caught, now the IRS says this is not reasonable, and so we're gonna come up with what number we think is reasonable. And
I don't want them coming.
Then we usually have to argue with them. Okay, so that's why we like to keep it a third, and so that's why you have a wage. I don't even know what is her wage.
I don't know.
24,000. So that's so if you're making around a total taxable income of 70-ish, you should be fine. 70 to 80, that sort of range. Now
I don't know.
We'll have to look and see. But that's one of the things we do each year. If it looks like it starts to creep down significantly below that third, we'll encourage you to bump it back up a little bit.
Okay.
And that's all it is. So this Social Security tax, that's it there. And it's double that because that's your half that's coming out. There's your Social Security withheld. There's your Medicaid withheld, Medicare withheld. That's the part of it's going to the Social Security.
Sure.
That's the part that's being held for your taxes.
Okay.
So and it may sound like a lot. I have people all the time that complain about this part. Well, gosh, that's times that by that's like $6,000 a year. Because it's 3 right there. No. So it's about $4,000 a year. It's about $4,000 a year. I don't want to pay that. And I go, well, fine. That means you're breaking the rules. So they're going to, let's go back to the original example where you're Schedule C. You would have paid
a lot
$7,000
more.
or $8,000.
Right, a lot more than that.
So which one
I'm concerned about underpaying.
Which
to tell you the truth
yeah, which
on
one
these
do you
things.
want? I mean, yeah. So yeah, you're fine. But I mean that's why your company is not actually paying any tax. It's all on your 1040. But you are getting both a W-2 and earnings from the company. That's the reason we do it this way. It's the only reason we do it this way.
Okay. Well, it gives you the paper trail, and you can see right where.
And the IRS likes it, and as long as you follow this schematic, I've never had a problem with it.
Okay.
Okay. So.
All right.
It works. It's a good system.
I may ask you again next year because a year from now I might
okay.
forget this. But
And I got to record this,
every bit of this.
and now I can
got it
let.
Today.